Hi, welcome to December quarter review from Independent Advisors WA. This is exclusively recorded for Mick Stefan's clients. My name is Max Riaz. I'm one of the investment managers and research analysts at Banyan Tree Investment Group, working very closely with Mick in bringing portfolio management to yourselves. Now, I want to cover off the quarter that just passed, the December quarter, but also I'll touch on the returns for the entire calendar year 2023, which ended with strong returns for equities. Now, the purpose of this or these updates, which are done on a quarterly basis, is to give you an update on the model portfolios that we've constructed for you, the ETF-based portfolios and the active fund manager-based portfolios. And there's obviously a lot of thought and thinking that goes behind these portfolios, and we want to be able to come back to you if you happen to be following these in entirety or to some degree or great degree, which we would encourage you to do, because they, as I said, they're well thought out, and I just want to be able to bring these to you as I do at these updates and talk about the returns from the lens of how these portfolios have performed, and hopefully along the way give you greater comfort in terms of us being able to deliver the returns that you expect us to do. So let's move along to the first slide, and I will start off with the ETF model portfolio for the moderate growth risk profile, so 60-40. The other risk profiles are similar in their returns as well. So this particular portfolio returned 10.5% for the entire year of 2023. It had a standard deviation of about 5.8%. What's standard deviation? It simply is a measure of how much the portfolio bounced around is expected returns. We tend to expect returns for this risk profile in particular of around 8%. If we can get more than that, that would be nice. And we actually got 10.5% last year. So over a long holding period, you will experience volatility of about 5.5%, either above 8% in any given year or below that. And if you average it out over 5 to 7 year holding period, your returns should be somewhere around the expected return of 8%. So that's the sort of bumpiness of this portfolio, which is pretty low. And we try to be very intentional about that. We don't want to set the portfolio as sort of a wild ride along the way in achieving the returns. So it's one of the lowest standard deviations for this kind of risk profiles in the market. So that's the return, 10.5%, which is pretty decent for last year, as I said. And as you know, the portfolios that we have constructed for you, the ETF ones and others in the active space, follow the ESG ethos and compliance, and sustainability is very much on the agenda for these ETFs. If you look back over the past 7 years, I'm showing you a chart here just to give you a feel for how individual year returns have been for ESG or sustainability focused ETFs. And last, it's been a good year last year. It was the third best year out of the last 7 years. And it was good to see performance come back around last year after 2022 being a negative year, not just for the ESG strategies, but also general market as well. So that's sort of the context we will be talking in the next few slides. One of a positive year for ESG equity strategies. This chart or table here shows you your model ETF portfolio. It has Australian equities at the top as an asset class. It's got international equities, property and infrastructure, These three comprise the growth part of your allocation, and then you got fixed income and cash in the defensives, with alternatives. At times we tilted to defensives, at times we tilted to growth. Right now it's set into the defensive, so it's counted as part of the defensive allocation. The Australian equities, as you can see, performed nicely. Those ETFs, we've got 3 ETF positions there, and they delivered circa 9 to 16% year per annum return last year, which is very good. But if you move along to the international equities, again 3 ETF positions there, and they had an even better return, 17% to 26%. Record returns, and these returns predominantly between Australian equities and international equities came from technology focused stocks. They had a good return last year. Consumer discretionaries, as they were heavily sold off in 2022, so they came back around. Healthcare stocks also did well. That's where the returns have come from. In international equities, some stocks are at their historic highs at the moment, so really good returns were had by all, should I say. Property infrastructure has also recovered from its doldrums in 2022. Fixed income has delivered as expected single digit returns, around 5 to 7%. Happy with that. Capital preservation was the order of the day, and even cash ETF, where we've got 6% allocation, delivered 4% return. So generally positive returns in fixed income as well, on the back of just higher interest rates. So all of our, or majority of our fixed income exposures are based off variable interest rates. So we're not taking that risk of inflation again ticking up for whatever reason, and there are a few, not expected, but if it ticks up again and interest rates move up a notch again, then we've taken that risk out to the extent we can, and your interest coupon will just go up yet again if that was to happen. Opposite would also happen as well. If interest rates get cut, which we don't think they will get cut back to 2% of 4 years ago, if there was a cut or two, then that will also be reflected in fixed income cash return. But the exposures we've got tend to focus on capital preservation as well, and that happens because of the actual quality of fixed income we're investing in is actually really high investment grade. So that's your sort of overall return, as I said, for your ETF based portfolio, circa 10.5%, consolidated across all those asset classes for last year. Moving on to your active model portfolio, again, positive returns, predominantly driven by Australian equities and international equities. Slightly lower than ETF based portfolio, but nonetheless strong returns in the active model portfolio as well. Now you may be asking, where did the returns come from in the Australian equities? First and foremost, in the ETFs and the active managers, Australian equities were a mixed bag. There were some sectors that did well and some sectors that actually went backwards, which most often, as you may know, happens in the market. So not all sectors are rising all the time. So last year, consumer staples was a sector that lagged after having a pretty strong year a couple of years before that. Coles was down 10%, Woolworths was flat, and A2 Milk was down 27%. That's mainly because the government's been clamping down on the supermarkets on how much they've been raising in prices in the name of inflation. Is it really inflation that causing them to raise prices in the supermarket, on the supermarket shelves, or is it they're just raising revenue to make more profit? Now that sort of has put a bit of pressure on these stocks, and also there were other sectors that were sold off heavily in previous years. So there's been some recycling of capital coming out of these well-bought sectors like consumer staples and moving in other areas. So that was one sector that underperformed last year, and materials as also has, you know, whipsawed or seesawed over past year, and generally trended lower, mainly because of China being a big consumer of materials and energy. That's China's obviously has had a, as you may have heard, economic slowdown, and so that's meant the demand for some of the commodities hasn't been all that strong. So therefore, BHP was down, slightly lower for the year. Rio was slightly positive. South 32 down 30%. Solid stock, but it's got certain metals that are just are seeing softness in demand. Some of the lithium stocks got to sell off as well, and that's sort of a shorter term weakness, which we think will come back around, as you've seen at the beginning of this year, and certainly from the late last year. There was a pretty good rally that came through in the materials sector. But on the whole, if you're looking at the window of calendar year 2023, materials lagged. Consumer discretionary stocks did very well, and they did well because they, for the good part of last year, they went sideways, but towards the end of the year they actually rallied pretty hard, and that was on the back of expectation that inflation is starting to settle down, and what that will mean is interest rates will start to get cut. We don't think they will go down to 2% necessarily, but start to come off from their highs and give some relief to the households, and therefore they will be able to go and have greater disposable income and go to places like Kmart owned by West Farmers or Bunnings or JB Hi-Fi and Super Retail Group and make their purchases, and therefore you can see the share prices have come off. I should say have rallied pretty hardly on those expectations. Moving into the banks, again, banks have had a good rally as well towards the end of last year. Has been a positive sector on the whole. CBA rose, ANZ had a good rally of 8%, but the insurers like Suncorp, IAG, Medibank, double-digit returns because of the just solid premium increases that they're passing on to the to their policyholders. So that's seeing good returns come through for the insurers. Now, moving on to the international equities, they did well. Predominantly, the US stock market did well on the whole, and within the US stock market, the technology sector did really well. I've just highlighted three stocks there for your reference. Nvidia, which makes smart high-end chips that go into electronics, your car dashboards running those screens have got Nvidia chips behind it, designed by Nvidia, and various other consumer high-end accessories tend to use these small chips designed by this company. And the demand has been, because we're moving into the world continuously evolving and expanding the world of digitization, that's going to mean that a lot of electronics, more and more electronics, that would mean the demand for these chips just continue to be quite strong. And you can see last year Nvidia chalked up over 200% return. Meta or Facebook, after a few years of doldrums, had a solid return as well last year of 155%. So that contributed to technology rally. And Nasdaq on the whole was up 44%, pretty solid return for last year. And Apple has had a, whilst it looks like at the bottom of all these others on this chart, taken on its own, it had a pretty good return of 22% as well. I'll take that any day. So that's where your international equities were making their bonanza. when your ETFs enjoyed circa 16% to 26% return last year in your international equities bucket. And these are the sort of companies that were producing returns. Now, international equities also have um, international equities also have regional exposure. So I mentioned the US equities did well, but we must compare US equities with other regional exposure. So Europe is one, um, and Asia. Now, S&P US stocks were up 20%. India was probably the only comparable market that grew as strongly as the US stocks. So India was up 20%. We've been talking positively about India for quite some time now, and certainly had allocations to India through the portfolios. We've been talking down about the prospects of China because of geopolitical reasons, and sanctions, and China not being able to pivot that seamlessly that it expects from being the factory of the world to being the mass consumer market, so that it can continue to grow at the rate that it enjoyed in the past. We didn't expect that to be the seamless transition, and that's certainly coming through. So the Chinese economy has been struggling this year and last year, and that's reflected in the Chinese share price as well. So China market has been down 16% last year, and certainly if you look at the Shanghai Composite Index, is down to at the COVID levels of 2020 March April. So that's where the weakness has been in the regional markets, and Euro stocks on the whole was up 10%. Now I want to mention something here which I was remiss of me to not mention it previously. The ETF model that we've constructed, and I've mentioned that the international equities have done really well. I just wanted to point out to yourselves that we were expecting to a great degree that international stocks were going to, on the whole, led by the US market, were going to put up a better return than the Aussie stocks this year, and we still think that will be the case in the near term forward. So what we did was, quite intentionally, over a year ago, allocate more of your portfolio or ETF portfolio to international equities. So as you can see on the screen, the international equities had 31% weight of the portfolio allocated, versus Australian equities had 25%. So those double-digit returns in international equities, with the greater weighting of the portfolio in those equities, helped us deliver the 10.5% in the aggregate return that we were able to last year. So I just wanted to point that out whilst it came to mind. So going back to so international equities on the whole, regions have had mixed returns. We were largely in the US stocks and technology stocks, so that's worked out well. And Europe as well has been good. India is positive. We remain quite constructive in Indian stocks. It's a long secular growth story that we will remain quite happily exposed to. So in the conclusion of this presentation, let me just reiterate that equities, we will be overweight ongoing for now in international shares, like we were previously. We do continue to like high quality growth sectors like technology, like healthcare, transition metals. Whilst materials had a softer year last year, we do think it will come back around. It's a once in a century kind of a transition going on from fossil fuels to renewable energies. There's no doubt about that, and electrification is a key theme, and there will be base metals and rare earths and manganese and lithium that will be in huge demand in the years to come. So we will remain positioned to those opportunities, and in emerging markets we'll remain weighted towards India and Brazil and these more North American markets. And so that's the sort of equities story. On the property and infrastructure, will remain at the lowest dial in allocation because of high debt position, higher interest rates will continue as a status quo for a while, even if there's an interest rate cut or two. We do think interest rates will remain reasonably elevated, and so therefore any company that has got too much debt on their balance sheet will have to sort of navigate through that period of next couple of years, and so would rather just sort of keep it at the lowest dial of allocation while that's happening. Fixed income, we'll happily investing in fixed income. So if our view is that interest rates will remain reasonably robust or elevated, I should say. So therefore, you've got a good return coming through for less risk. So why wouldn't you take it? So we are taking it. So mid-digit kind of returns, 5-6% in income through higher quality credit, where it's managing volatility of the capital at the lowest dial possible. Then that's fine. We'll take that. So that's how we're investing, and we're holding a bit of cash in the models as well. And the one that I shared with you before, it's got about 6% cash allocation. So if growth markets do have a bit of a pullback, we can go in and invest a bit more into undervalued opportunities. So with that, I will conclude this presentation, and I hope to see you next time. Till then, goodbye.